Welcome back to the PNJ Group series on the FASB Conceptual Framework. We now know the 10 elements, but meeting the definition of an asset or a liability is only half the story. The next question is whether that item actually belongs in the numbers on the face of the statements or only in the footnotes. That is the job of recognition, and its counterpart, derecognition. This is where definitions turn into journal entries, so let's get it right. By the end of this section, you will be able to define recognition and derecognition and explain how they differ. You will apply the 4 criteria from SFAC 5 that an item must meet to be recognized. You will distinguish recognition from disclosure, a line that trips up many preparers. You will identify what triggers derecognition for assets and liabilities. And you will understand the unit of account, the quiet decision that shapes what you are even measuring. Let's start with the basics. Recognition is the process of capturing an element in the financial statements through formal inclusion. In plain terms, it means the item lands in the actual line items, the assets, liabilities, revenues, and expenses, not merely in a disclosure. Derecognition is the reverse. It removes a previously recognized item when the criteria for recognition are no longer met. Think of recognition as the front door and derecognition as the exit. An item should walk through each door at exactly the right moment, and a big part of accounting judgment is deciding when that moment has arrived. Under SFAC 5, an item is recognized only when all 4 criteria are met at the same time. First, it meets the definition of an element. Second, it has a relevant attribute that can be measured with sufficient reliability. Third, the information is relevant, capable of making a difference to a decision. And fourth, it is faithfully represented, complete, neutral, and free from material error. Notice how the qualitative characteristics from the last section reappear here as gatekeepers. All 4 must hold together. Fail anyone, and the item does not get recognized, even if it clearly exists. Here's where things get interesting. An item can meet the element definition yet fail a recognition criterion, most often because it cannot be measured reliably. When that happens, you disclose it rather than recognize it. Classic examples are contingent liabilities that fall below the probable threshold under the loss standard, and certain internally generated intangibles. But hold on to the key principle in both directions. Disclosure is not a substitute for recognition when all the criteria are met. And when the criteria are not met, recognition is not required, though disclosure still might be. Recognition and disclosure are different tools. Now to the exit door, starting with assets. You derecognize an asset when the entity no longer controls it, having transferred substantially all the risks and rewards, or otherwise lost control. That control test is the heart of it. The 2 standards you will meet most often here are the Financial Asset Transfer Rules, a SC 860, which govern things like selling or securitizing receivables, and the lease modification rules under a SC 842. The surprising part is that legal form does not decide this. You can still hold title and have derecognized, or release title and not have, if control tells a different story. Liabilities come off when the obligation is discharged through payment, canceled by the creditor releasing you, or simply expired. For debt specifically, a SC 47050 governs extinguishments and modifications, and the line between a modification and an extinguishment carries real accounting consequences. There is also partial derecognition. An entity can derecognize just a portion of a financial instrument when it transfers one component while keeping another, for example selling a participation interest in a loan while retaining the rest. So derecognition is not always all or nothing. Sometimes only part of an item walks out the door. One concept quietly governs all of this, the unit of account. It determines what is being recognized and measured, whether a single item, a group of items, or one component of a larger arrangement. This sounds abstract until you see how much it drives. The unit of account shapes goodwill impairment testing, how lease components get identified under a SC 842, and how performance obligations are separated under a SC 606. Here's the practical lesson. Before you measure anything, decide what the thing is. Pick the unit too broadly or too narrowly, and every number after it inherits the error. Let's tie it together. Recognition formally captures an item, and it requires all four SFAC 5 criteria at once: definition, measurability, relevance, and faithful representation. When an item fits the definition but fails a criterion, you disclose rather than recognize, but disclosure never substitutes when the criteria are met. Derecognition removes items, turning on loss of control for assets and discharge for liabilities, and it can even be partial. And every one of these judgments rests on first fixing the unit of account. Next, once an item is recognized, at what amount? That is measurement. Thank you for completing this section on recognition and derecognition.